I'm a little nervous. I haven't given this presentation before. It's a new one. Yesterday, I cited several brilliant and highly successful traders who, after years and years of outstanding and consistent performance, eventually veered off course and sabotaged their success by breaking the rules. Some, like Ray Dalio, learned from their mistakes and evolved into truly consistent winners with steadily rising equity curves. Others, like Victor Niederhofer and Jesse Livermore, continued to eventually slide down after each successive run and were relegated to merely being boom and busters. And sadly, there's another trader to add to that unfortunate list, this handsome guy. I'm guessing you may not have seen that coming. I'm ashamed to admit that after years and years of consistent and frankly exceptional results, I too sabotaged my success over the past several years by breaking just about every rule I stand up here telling you not to break year in and year out. So I too have not achieved that coveted and elusive status of consistent winner that all traders aspire to, but so few achieve. This afternoon, I'm going to share my personal journey as a trader. From humble beginnings as a new employee at William O'Neill & Company with virtually no knowledge or experience in the stock market, to current day with years of experience and lessons learned the hard way. We're going to take a ride on my roller coaster equity curve over the past 2.5 decades. And like any responsible operator, I have to forewarn you, this ride is not for the faint of heart. So if you're pregnant, have any heart problems, back or neck issues, or are prone to dizziness or motion sickness, I recommend you wait outside. This section of the workshop is not presented in your workbooks. This is my own personal journey with my own personal money. And I want to make crystal clear that this is not my performance in the firm and the various accounts I manage for O'Neill. My performance over the past 20 years in the firm resembles a stair-stepping equity curve that hit an all-time peak earlier this year. It's the type of equity curve you would expect from a consistent winner. And that's not to say that I haven't had drawdowns or periods of underperformance that were larger or lasted longer than I would have liked, because I've certainly had both. And like anyone, I am not immune to making mistakes, and I have made many over the past 20 years. But I've never made any in the firm that would destroy my equity curve. And I think when you are accountable to another person who not only entrusts you to grow their money, but also to protect their money, then you're less prone to making some of the egregious mistakes that can destroy a portfolio. In any event, my journey is at once a cautionary tale, a confessional, a thrill ride, my own self-therapy, and the culmination of lessons learned over the past 25 years. I'm going to get a bit personal with you. I've never given this presentation. I'm hoping I don't get emotional. Some of you may not believe some of the figures that I'm going to put up, especially given from where I started. And if I hadn't lived it, I may not believe it either. I assure you all the numbers you're going to see are truthful and accurate, because if there's one thing that I have done consistently over the past 25 years is keep meticulous notes and records. So buckle up and enjoy the ride. The beginning of my trading career really coincided with my hiring at William O'Neill & Company as a research analyst. For the 5 years prior to that, I was an analyst at a boutique real estate consulting firm. Now, I've always been interested in the stock market. Back then, I didn't know anything. I had never made any money in it, but I loved it. In fact, my first investment wasn't even in a stock at all. It was in a mutual fund. When I was in college, in the 1980s, a friend of mine suggested I buy the Fidelity Magellan Fund run by the legendary Peter Lynch. And I took his advice and I bought it in August of '87. I honestly think I top-ticked the market to the day. 2.5 months later, I had lost a third of my bar mitzvah money. My knowledge back then came from watching Louis Rukeyser's Wall Street Week every Friday on public television. And my only strategy was trying to find the lowest PE stocks I could. Now, for my first day at O'Neill in the research department, I loved it. I had access to all kinds of broker reports, real-time quotes, an unlimited amount of data, and of course, stock charts. When I saw those broker reports, I thought I had struck gold. I mean, I had all of the analyst recommendations for all these different stocks, and I was very excited about it. I remember calling my wife from my cubicle and saying, "Honey, we're going to be rich." And my strategy was simple. I combed through all the reports, and I looked for the report that had the biggest projection and increase in price over the shortest period of time. It was that simple. So I clearly remember my first investment. An analyst at Solomon Brothers had written a report on a little company called Today's Man. Has anyone heard of it? Okay, it doesn't surprise me. They were a men's clothing retailer in the Northeast. Let me give you a tip. Never invest in men's retail. Men don't even shop. They hate shopping. Anyway, he wrote a report, and he projected the price was going to double in the next 6 months. So I bought in at about $4.75 a share in November of '95. A month later, the stock had fallen 50%. I took a 41% loss, but I learned an important lesson. Never trust an analyst's recommendation. So, that was my start, the last 2 months of '95. My $1,500 account was now just $900. So I transferred another $2,000 into my account, so I had a little bit more to trade. And I still had no clue what I was doing, but I knew, don't trust the analysts. At the time, I was reading Bill's book. I was learning how to analyze charts, and I had started studying for the CFA exam. And my intention at the time was to get my CFA designation and then work at a buy-side or sell-side firm. And I was obsessed with the stock market. I stayed late every night after work, researching stocks, studying charts, and so forth. I would come in on weekends as well. I liked buying low-price stocks. I didn't have much money. I liked to buy round lots. And I like to buy on pullbacks, a strategy that I still use today. Now, back then, trading commissions were really high. Even at a discount brokerage, they were high. So with my little account, I really couldn't afford to be buying lots of stocks and racking up these commissions. They really dug into my results. So I would basically limit my portfolio to just 1 or 2 stocks at a time, which meant I either put all my money in a stock or half my money in a stock, maybe a third. But I was taking very large positions relative to the small size of my account. So when I was right, it had a big impact on my account, and when I was wrong, it was pretty bad. So through the first few months of the year, I was pretty haphazard, but I was making money. But you could see that I'd either have big months or bad months. But all in all, I was in the black. And then in August of 1996, a little company came public called Srs Labs. They were a maker of audio enhancement software. Basically, they could take regular speakers and turn them into 3D sound. So I bought into that company right after it IPO'd, after this little tight area, and the stock exploded. By the end of August, my account was up 122%. I could still remember visiting the company's website and listening to the 3D sound coming through the speakers. Now, I will be honest with you, I really couldn't hear the difference. But I wanted to hear the difference. I mean, I was making money in this stock and I loved it. So I decided to add another $2,250 to my account. Now, maybe I wasn't the only one that couldn't hear the difference, because by year end, the stock came all the way back down. Unfortunately, I had no sell rules. And between holding the stock all the way down and adding to my position, my triple-digit gain turned into a 24% loss by year end. I started with $1,500. I'd added an additional $4,250, and by the end of my first year, I had just over $3,000. I lost about half my money. At the end of '96, I did something that was a game changer for me. I did exactly what Bill would have suggested. I did a post-analysis and I wrote down some rules to govern my trading. I still have that original document today. My basic rules were these: preservation of capital. Never take a big loss. Number 2, always have an expectation of what a stock should do, and if it violates that expectation, sell it. And 3, trade in line with your personality. Now, those of you that know me know that I'm a little more of an active trader, and I would consider myself a singles hitter. When I swing for the fences, I usually strike out. So I basically decided to embrace my short-term nature and adopt a swing trading approach. Now, what I had not done by that point is really just focus my buying on buying leadership and breakouts. I was doing that too, but I was also running all kinds of different strategies. I would try to buy stocks that were breaking down fast, trying to cash a quick bounce. I was trying to buy stocks at the bottom of a base. I figured, why wait for the stock to break out if you can buy at the bottom of the base? It made no sense to me. I didn't realize at the time that you don't know it's the bottom of the base until after the fact. I figured that out later. So I started over again in 1997, this time with a fresh set of rules that I vowed to follow, and we were in a strong bull market. The NASDAQ in '97 was up nearly 22% for the year, but the first few months were pretty tough. The market corrected about 15% off the highs, but I wasn't paying any attention to the general market at that time. I was just focusing on individual stocks, trying to pick some short-term winners, and I figured that there's always something working regardless of market conditions. So the year started off with a bang. I was up 37% in the first month of the year, trading Remick, which is a little company I made 23% in 6 days. I probably had my whole account in it on margin. However, by the end of April, I came back down with the market and actually gave it all back and then some. So I was down for the year again. However, by the end of April, the market followed through and had a huge 41% advance through mid-October. And that's where things really started to take off for me. Remember, I was trading a very concentrated portfolio relative to the small size, and I was looking for quick profits, doing my little swing trading, and I was immediately redeploying my winnings and trying to compound my account as quickly as I could. So I did well in stocks like Maverick 2, which I traded throughout the year. Trust me, I didn't buy it and hold it the whole time, but I was trading it. I did well in engineering animation, which I bought and sold again and again for profits. I did well in Peregrine Systems, made 37% in 2 weeks. And I got lucky on some oversold bounces. Made 32% in 4 days in ACT Networks and 16% in 4 days in Simulation Sciences. With the use of full margin and short-term compounding, I was up 130% by the end of May. I had reversed all of my previous losses from my start. I was finally in the black. I decided to add another $4,250 to my account, bringing my total capital outlay to $10,000. Now, at the time, with the additional money, my equity, my account was really only at $11,000. So I really hadn't made much money over the previous 18 months, but I was in the black, the wind was at my back, and the momentum was building. I made a few good trades in Halter Marine and Paragain Technologies. And by the end of July, I was up 223%. I was trading without a trace of fear. There was absolutely no hesitation or resistance. I was in the zone. I had very few losing trades during this period, and when I did have a loss, I was cutting them between 5 and 8%. In August of '97, I decided things weren't moving quite fast enough, and I discovered options. I figured, why shoot for a quick 15 to 20% gain when the option will double or triple in that time frame? Now, I've had a love-hate relationship with options ever since. I've never used them in a responsible way, the way they're intended. You should use options to hedge your risk, to mitigate your risk. I have only used them to increase my risk and increase my leverage. And that works great when things are going your way, and it's devastating when they don't. Took me a while to figure that out. In the second half of '97, about half my trades were in options. Instead of buying a large position in the stock, I would buy a fairly large position in the option, ranging between 10 and 15% of my account, which is pretty big for an option position. Here are an example of some of those trades. DSP Group, and this is a model book stock, made 286% in 5 days. Whole Foods, I traded again and again with gains of 130 to 360%. Avid Technology up 50% in 10 days. Gradco, this was a stock buy, 25% in 10 days. System and Computers, 228% in 8 days. By the end of '97, I was up 710%, and my little account had grown to $40,000. I continued to trade aggressively into 1998, although my focus turned back to stocks, having sustained a few bad option losses at the end of the previous year. The market was strong during the first half of '98, with the NASDAQ moving up 29% to its peak. By far, my biggest winner was engineering animation, which I had traded the previous year as well. It was trending perfectly and holding the 50-day moving average, and you can see it gave many opportunities for a swing trader to buy. I'd buy it off the 50, sell it into strength over and over again. It was by far my biggest winner over the previous 18 months. It had moved up 300% from its initial breakout. It was my reliable go-to stock that I made money in time and time again. By the end of April, I was up 62% for the year. My account had grown to nearly $65,000, and for the first time, I decided to take some money out of my account, transferring $7,500 into savings. By the end of June, I was up 110%, and my account was up to $73,000. I was now up 1,600% in 18 months from when I wrote down my rules. Little did I know we were on the brink of my first legitimate bear market, and sadly, I had missed the M in Untitled chapter. As I mentioned, I never paid much attention to the action of the general market back in those days. I just happened to be lucky to be trading in a secular bull market. All that changed in July of '98. The market peaked July 21st at 2,028, and within 3 months lost 33% of its value. Now, I had been through some intermediate corrections in the previous year, but nothing like this. In August of '98, the Russian government was forced to devalue their currency and default on their debt. The renowned hedge fund Long-Term Capital Management blew up in the process, and markets everywhere were affected. The Federal Reserve was forced to go in and coordinate a bailout. In July, my account was down 28%. In August, another 18%. In September, another 29%. In October, another 15%. In the course of 4 months, my account went from being up 110% to being down 24% on the year. My account was back down to a mere $26,000. I was shell-shocked. I had busted. I was 64% off my highs in 4 months. 2 things led to my ruin. My persistence in fighting against the market, trying to swim against the tide. And that has always been my weakness. As I mentioned yesterday, I've always tried to make money in every kind of market. I've always thought I'm smart enough to find that rare winner in a sea of red. And my other thing that led to my ruin was my insistence on trying to pick bottoms. The truth is that it's all but impossible to consistently pick a bottom in a falling stock. You're going to be wrong much more than you're right. And even if you diligently cut your losses at 5, 6, 7%, if you take 10 or 15 losses in a row trying to catch a bounce in a low percentage strategy, you're going to blow up. Now, can you guess the stock I kept coming back to again and again? Engineering animation, the one I had made all that money in. As well as it did, it was massacred when the market corrected, falling 60% in a few months. Each time I would go in and try to catch a bottom, I would lose. I would cut my loss and try again and again. Now, in my experience, buying pullbacks in an established uptrend is the most profitable and least risky strategy in a bull market. And that's what I do. But in a bear market is a terrible strategy. By the end of October, I was devastated. I was discouraged and I began to doubt myself. I wasn't sure if that 18-month winning streak was a result of my trading acumen or just blind luck. Now, a few months earlier, I had earned my CFA designation. And if you recall, my original intention was to be an analyst at a firm, at a buy-side firm, a sell-side firm, writing up reports. I had given back the bulk of my gains in such a short period of time that I thought that maybe trading wasn't for me. And so I started looking for a job. And I nearly got a job at a small boutique money management firm, but ended up getting passed over for a guy with much more experience. Well, the gods must have been smiling on me because I was on the brink of starting a run that would change the course of my life. The market bottomed in October of '98, October 8th. A week later, Alan Greenspan, the Federal Reserve Chairman, lowered rates for the second time in 3 weeks, and the indices staged a massive follow-through. From the market low on October 8th to the peak at the end of the year, the Nasdaq rallied an incredible 62%. With the bull back in full force, I started to make money again. I managed to make 35% in November, another 27% in December, and by the end of the year, my account was up 29% for the year. My account had bounced back to $45,000, and I had regained my confidence as we went into 1999. Can anyone tell me off the cuff how much the Nasdaq was up in '99? Just off the cuff. It was up an astonishing 86%. I had to recheck my numbers like 5 times because I couldn't even believe it, and I traded through it. Now, in 1999, I made over 700 trades. Those are round trips. That's an average of 60 trades a month, and that's a lot of trading. So there's too many trades to highlight. Keep in mind, actually you don't know this, at the time, O'Neill had a discount brokerage, and I had to trade through it. I worked at the company, I traded through the O'Neill discount brokerage. I traded so much in '99 that I paid the firm back twice what they paid me in salary. True story. During that year, I traded primarily stocks. I didn't trade options. I stayed true to my strategy of short-term singles, and I tried to compound my money as quickly as I could. My win-loss ratio in '99 was about 60%. My average holding period was 7 days. My average gain was 16%. My average loss was 6%. Now, those stats might not seem that impressive, but they resulted in being up 10 out of 12 months. 8 of those months were double-digit months. Of those 8 double-digit months, 5 of them were monthly gains of 39% or more. I ended '99 up 1,031%. With over $500,000 in my account. I promptly took out $180,000 to pay my tax bill. I was feeling pretty good about myself. Well, that might be an understatement. I thought I was a market wizard, and I thought it was only fitting that everyone knew that. My wife cringed when she saw that license plate. Gil Morales, one of the PMs at O'Neill, called to tell me I was an idiot. He said, that's a bad omen of things to come. And he was right, but he was a little bit early. Later that year, in 1999, an amazing thing happened to me. Something I had always dreamed of, but never expected. I got a visit from Bill. Now, Bill rarely came up to the research department. He really came up about once a year to give us a pep talk, to give the analysts a pep talk, tell us, we should get involved in the stock market and tell us the amazing potential to change our lives. Now, the head of the research department was aware I was an active trader, and I had asked her that if there's ever an opportunity in money management, I'd like to be considered, because no one knew who I was. I was just a research analyst in the research department. And remember, I was trading through the O'Neill brokerage, so they can, if they wanted to, can monitor how I was doing, and they could audit my performance. So one morning, I'm sitting at my desk, and in walks Bill. And he walks right over to my desk and pulls up a chair. I could see all the eyes in the department were on me. And we chatted for a few minutes, and he said, let's grab some lunch. He took me to Soup Plantation, and he said he needed a research analyst to support the PMs. I said, how about making me a PM? He chuckled and said, all in due time, right now I need an analyst. Of course, I accepted the position. Now, he did have some prescient words of wisdom for me a few weeks later at the firm Christmas party. He asked me how I was doing for the year, and I told him I was up 1,000%. And he said, just remember, we all put our pants on one leg at a time. At the start of 2000, I moved into a cubicle right outside Bill's office. He set me up with real-time quotes and our Wanda charting service and turned me loose. Now, I was an analyst for the PMs, and every so often I would write a one-page report on some stock the guys were trading or were interested in, but they really didn't ask that much of me. And so I was pretty much able to trade my own account, my own personal account, with very few distractions. And I did a lot of trading. The first 2.5 months of 2000 started back where the previous year ended. The NASDAQ was up 26% in that 2.5-month period on top of the 86-month gain the year before. The market was euphoric. Stocks were going crazy. Climax tops, which are typically pretty rare, abounded. Everyone was getting involved in the market. The market pundits were saying that there was a paradigm shift, that the old rules don't apply. When that kind of thinking becomes commonplace, you know you're near the end. As Livermore said, there's nothing new in Wall Street. My biggest winners during that little 2.5-month period were in the internet and biotech sectors, which were on fire. Some of my winners were Novin Pharmaceuticals, Genesis, which was my biggest winner, and Connexin Systems. You can see the stocks were just going insane. Every stock was going insane. In the month of February alone, I was up 93%. And I hit a milestone. I had my first 6-figure day. I had 2 more of them in the next 5 trading sessions. The market peaked March 10th of 2000, and I was up 240% by that day. I was making more money than I ever imagined. I decided to wire another $325,000 out of my account. Following the peak, there was a brief pullback and bounce off the 50-day moving average. And then the market fell apart. Within 5 or 6 weeks, the NASDAQ had broken 36%. Stocks were crashing. Genesis, my biggest winner, was down 70% by the end of March. Toward the end of May, the market was down 41% off its highs. But a very strange thing was happening. I kept making money. I got lucky cashing a few oversold bounces. I made money shorting the market and buying some put options. And that's something I never did, but I guess I did it for the first time and made a little money. By the end of April, I was up 29%, and I held my gains, being down just 5% in May. I decided to wire another $150,000 out of my account. At the end of May, the market followed through and had a 7-week tradable rally, advancing 24%. And I remember it well because this is the exact time that Bill made me a PM and staked me with some money. In the first 6 weeks of trading the firm money, I was up 50%. And for a short time, I was flavor of the month. Bill moved me into his office. He became a mentor to me. We spoke every day. I went on business trips with him, and I felt we became really close. Likewise, I was killing it in my personal account. During this rebound rally, I was up 25% in the month of June and another 17% in July. After a brief but significant 18% pullback in the second half of July, the market had one last bounce to challenge the July highs, advancing 21% off the lows. My personal account was up another 50%. By the end of August, I was up 652%. We had just closed escrow on a brand new home, beautiful home, but I was doing so well, I was already looking for something bigger and better. I remember telling my wife at that time, I would never make less than $1 million a year, and I would never be up less than 100% a year. That was my worst case scenario. I peaked September 14th, 2000, up 824% for the year, and that's following a 1,000% gain the previous year. At that time, the NASDAQ was down 4% and 24% off its March high. On my peak day, I was up 109,000% from the start of my 1997 trading when I started with my rules. That's compared to 203% for the NASDAQ. My investment had grown from an average capital outlay of $7,500 to nearly $2 million. And it would have been much, much higher if I hadn't taken so much money out of the market on the way up. Even so, that's a 250-fold move without a single long-term capital gain. It was exhilarating and it was intoxicating. Up to that point in the year, I had made over 1,000 trades, and I was printing money even with the market well off its highs. And I couldn't stop trading, and I didn't see any reason to stop. So the bear market really got ugly right after that point. The NASDAQ fell 40% into the end of the year, and it was impossible to make money on the long side, and that's how I traded. In the 2 days following my September peak, I was already off a quick 14%. And at that point, I made one of the smartest decisions of my life. Remembering how I busted in 1998 and feeling that I was losing control, I began wiring money out of my account, big chunks of money, in an effort to protect myself from myself. In September, I transferred another $600,000 out of my account, followed by another $150,000 in October. I diversified by buying a limited partnership in real estate. I put some money in mutual funds for the long term. I put money away for private school and college for my young kids. I put money aside to finish our home, the landscaping, and build a pool. I put money aside to pay taxes, and I had money left over for a rainy day. But I couldn't stop trading. I was like an addict. I kept trading and I kept losing into the end of the year. By the end of the year, I had managed to wire out close to 70% of my assets, of my money, from my September peak, but most of the remainder I lost by year end. And I was burnt out and I needed a break. So, at the beginning of 2001, I decided to focus all my efforts on trading our retirement accounts, as opposed to this tradable margin account that I just showed you. All of my trading up to that point were short-term capital gains, and I was bitter to be splitting my profits with the government year in and year out. It would be many years before I restaked my tradable margin account with any size. So my main trading vehicle became my wife's SEP IRA account. And it had been growing nicely over the years, nowhere nearly as quick as that margin account, but I traded it more slowly, more conservatively, but it had done pretty well. Now, by this time, again, I was so burnt out and exhausted from so much trading, I decided to really emulate Bill a little bit more and try to focus on capitalizing on some big winners. Jesse Livermore's words resonated with me. It's the big swing that makes the big money for you. So 2001, the first quarter 2001, was a rough time in the market. After following a brief rally in January, the market went to a tailspin, falling 44% into early April. But lucky for me, I had come across Skechers, and I traded it aggressively during the first half of 2001. I entered the trade the day before the breakout, and I traded around a core position. By the end of May, I was up 121%, while the NASDAQ was down 15%, although I did give back a chunk of money as the market rolled over. Now, in September, the nation suffered the 9/11 terrorist attacks. I remember driving to work that morning, listening to the news commentary of the planes hitting the Twin Towers. The market didn't open that day and it remained closed for 4 days. When it did finally open, it corrected 18% in 5 sessions. It then found a bottom staged a 5th-day follow-through at the end of September, and rallied strong through the end of the year, rallying 41% off the lows. Defense stocks, anti-terrorism stocks, and cybersecurity stocks were the big leaders. For the remainder of the year, I made big money in Bradley Pharmaceuticals, Visionics, which was a facial recognition software company, and Entrust, which was a cybersecurity turnaround play that I had a precedent for. By the end of 2001, I was up 229%, with the NASDAQ down 21%. Not a bad way to end my first year trading the retirement account. And I didn't pay a penny in taxes. I was emboldened and I began to dream. This is when I created that spreadsheet I showed you yesterday on my road to $1 billion. Now, as I mentioned, I had a precedent for the Entrust trade. It was another little cybersecurity turnaround called secure computing. Now you can see this, you can't see the action up here, but the stock was way up here. It fell, had this kind of climactic gap down, this long consolidation phase, and then it perked up, came back into the 50, had a huge move up, and then another pullback to the 21-day moving average. The stock was up tenfold in 20 weeks. Entrust, similarly, had a deep fall from grace, big climactic gap down, consolidation phase, perked up off the 50-day, pulled into the 21-day, rushed up, and came back in. Exact same looking chart. Now, Entrust was up over 200% by early January. And based on the precedent, the secure computing precedent, which went up again tenfold in 20 weeks, I expected Entrust to double again within the next 4 to 8 weeks. Now, I was up huge on the stock. My confidence was surging. I had built a 75% position in the stock going into earnings, expecting the gap up. What I got was a gap down. The stock closed down 31% that day on ginormous volume. My account was down 25% in a day. Now, from that point forward, things got worse. 2002 was a brutal year in the market. The NASDAQ fell 8 of the first 9 months, correcting 41% to its low in October. In typical form, I continued to swim against the tide, doing my best to make money on the long side in a sea of red, but it was just too difficult. By the end of September, I was 50% off my highs. My compounded gain had shrunk from 229% to just 53%. I had busted again. The bear market ended in October 2002. The NASDAQ had fallen an insane 78% in 2.5 years. On October 15th, the market staged a powerful 4th-day follow-through and rallied 37% over the next 6 weeks. With a turn in the market, my account stabilized, but I was psychologically wounded, and I didn't take full advantage of the huge bounce off the bottom. I ended 2002 down 50%. It took until April 2004 for my equity curve to get back to new highs. That's 2 years and 3 months of precious time lost just getting back to where I was. This leads me to talk about the power of compounding. The secret to building wealth is to harness the power of compounding. Now, the power of compounding requires 2 essential elements: return on investment and time. You need both or it doesn't work. Now, by definition, only the consistent winner can harness the power of compounding. It doesn't work for the boom and buster because they take too much time making back all their losses again and again and again. In March 2003, we saw the start of a new secular bull market. The next 5 years were a great time to be trading. There were many great model stocks during this period that made amazing moves. Once again, I vowed to stick to my rules, and I began a long run of more consistent results. During the 5 years from 2003 to 2007, I traded like a consistent winner. Now, to be sure, I made mistakes, but none of them were fatal mistakes. For the most part, I handily beat the market by a wide margin. I wasn't experiencing the crazy performance I had in my margin account in the late 90s, but you have to remember, this was not the tech bubble. The tech bubble was its own special, unique period, which we may never see that again. It was kind of a once in a lifetime. And I was also trading without the use of margin, which limited my upside, but to be fair, it also limited my downside. During those 5 years, my SEP was up 452% for a CAGR of 41%, compared to the 99% return of the NASDAQ, which is a 15% CAGR. Some of my winners during that time period were, that's my performance over that 5-year period. Some of my winners were LaserScope in 2003 and 2004, MGI Pharma, Apple in 2004, 2005, Intuitive Surgical. These are all great model book stocks. Google, and in 2007, Baidu, and First Solar, which is one of my biggest winners. So those are really great years. But we were on the cusp of the financial crisis and our second major bear market in a decade. So again, 2008 was the financial crisis, and it was a terrible year, except for a couple of short-term bounces, little tradable rallies. The trend was distinctly down, and the only thing to really do was to stay out of the market. That's precisely what Bill had the PMs do in the firm. But in my personal account, I did what I always did. I tried to find the rare winner amongst the sea of losers. And for a while, I held my own. Going into the end of August, I was up 8% compared to the NASDAQ's 9% loss. But by the end of September, all hell broke loose, and the indices started to crash. From mid-August through mid-November, the NASDAQ plummeted an astonishing 48%, and I went right down with it. By year-end, I was down 29%, compared to the 41% drop in the NASDAQ. It wasn't a good result, but it could have been worse. It could have been a lot worse. So I licked my wounds and prepared for the next bull market. March 9th, 2009, the NASDAQ hit what would turn to be the bear market low, down 56% from the November peak and still down 75% from the March 2000 peak. On March 12th, the S&P 500 staged a follow-through day, a 5th-day follow-through, and suddenly we're in a new bull market. Now, like the 2003-2007 bull market that followed the tech bubble burst, the bull market that followed the financial crisis was powerful and consistent and offered amazing opportunities to parlay your wealth. My returns were strong and consistent over the next 5 years, again, handily beating the performance of the NASDAQ. I again experienced what it was like to trade like a consistent winner. Over that 5-year period, I was up 660%, a 50% CAGR, compared to NASDAQ's formidable 165% return, or a 22% CAGR. Some of my big winners during this period included Green Mountain Coffee, SourceFire, Apple, and Acme Packet in 2010 and 2011, And then towards the end of 2011, I caught the turnaround in the housing sector after a nearly 6-year rout where the publicly traded home builders had fallen by 80 to 90%, and the private home builders had either gone bust or were acquired or merged. Now, this was a trade. This home building trade was something that I had been planning and patiently waiting years for. In fact, I did a whole presentation on this trade at the 2012 Master's Workshop. I doubled my money in 2012, primarily trading the housing stocks. So you can imagine that I was feeling pretty good about myself by the end of 2013, and I was proud of my performance. Over the 13 years from 2001, I was up 4,800%. This is in a non-margin account. That's a 35% CAGR, compared to the NASDAQ's 69% return, or a CAGR of just 4%. My net worth was building, and I was compounded annual growth rate. My net worth was building, and I was dreaming about a bright future of abundance and wealth. As we entered 2014, one of the stocks I was following closely was Tesla, which had staged a massive move the previous year and had built a second stage cup with handle base. Tesla was one of my biggest winners in the firm that previous year in 2013. I knew it well, and I had a lot of confidence in it. And this stock also reminded me of a stock I did very well in 6 years earlier, First Solar. These stocks behaved almost exactly alike during their initial breakout runs. And I was betting that Tesla might act like First Solar coming out of this second stage base. And indeed, they traded exactly the same until they didn't. You can see First Solar built the second stage cup with handle, broke out around the 50-day moving average, ran up, had 3 pullbacks to the 21-day moving average, had a little gap up, and then a gigantic gap up. Tesla formed a second stage base, broke out at the 50-day moving average, ran up, had 3 pullbacks to the 21-day. This one stopped at the 10, had a little gap up, and then a massive gap up. Exactly the same. It was uncanny how similarly the stocks traded. It was as if I could see the future. My conviction soared with the size of my position. I had so much confidence and was doing so well in this trade based on the precedent that I started to buy call options, lots of call options. On February 25th, when Tesla had that huge gap up, just like my president had predicted, I had my first 7-figure day. My account was already up 62% on the year, and we weren't even into March. I was trading from home that day, and I remember calling my wife over, and I said, "Look at this." I was beaming. There is no better feeling than having your analysis and expectations realized on a well-planned trade. It is intoxicating. She looked at me and said, "Honey, that's a lot of money. Maybe you should sell and take a break." I said, "Sell? This is just the beginning. I've worked hard all these years just to get to this point. We're at a new starting point now. This is where things start to get really exciting." I peaked 6 days later, up 71% year to date, up 8,300% from my start in 2001. Now, the truth is, by this time, I had made enough money so that we could live very, very comfortably for the rest of our lives. But I wasn't satisfied. I was really dreaming big. I fashioned myself as a modern-day Jesse Livermore. I would buy a big home on the beach in Malibu and throw lavish parties for all my friends. Not that I was anywhere as rich or successful as Jesse Livermore, but I figured that if I could double my account by year end, which I thought I'd have no problem doing, then I could pretty much do whatever I wanted and live wherever I wanted from that point on. And I hadn't even reached my 50th birthday. And this money was tax-free. I had converted it to a Roth IRA years before and paid the taxes. Now, the funny thing is that anyone who really knows me knows that I would hate living like that. And that's really not me, but maybe that's who I thought I should be. We'll get to that later. So anyway, back to the First Solar precedent. I was anticipating a similar run in Tesla's First Solar. First Solar moved up 160% in 14 weeks, so I figured Tesla still had 6 weeks to go, but it wasn't to be. Instead, Tesla started to fall, along with a whole cohort of other high-flying stocks. The precedent was broken, but I refused to believe it. I had been so right that it was impossible to be wrong. It is hard for me to explain to you what happened next. It is painful and it is embarrassing, and it's as if something broke inside my brain. I began a long and severe downward spiral unlike anything I have ever experienced. Over the next few years, I slowly turned away from everything I knew about the market, everything that led to my success, and I became the worst type of amateur. One who's emotional, fearful, didn't trust himself, and either had too much or not enough confidence. Tesla came down to the 50-day moving average, found support and bounced for a day, and then undercut the 50-day moving average. All the while, I was buying more and more call options, anticipating a sharp recovery. Now, I was aware that the precedent was broken, but I stubbornly held on anyway. By the end of March, just 4 weeks after peaking, I had given back all my gains and then some. I took massive losses on my options, most of them going to zero. Millions and millions and millions of dollars down the drain. And from that point on, I really struggled. My head was in a bad place. I was flailing. I should have stopped altogether, gather my thoughts, get my head on straight, but I didn't. I kept trading and nothing seemed to go right. By the end of October, I was down 36% and 63% off my highs in just 7 months. I managed to stabilize by the end of the year, but I had busted again. A spectacular 13-year run. By the end of 2014, I was down 26% for the year and a depressing 56% off my peak. During the first half of 2015, the market traded in a choppy fashion, but with an upward bias. And it wasn't up much, but this kind of market with the frequent pullbacks did offer opportunities for someone who could swing trade. And I did okay. Now, my mental state was still injured. I was very disappointed, but I had done a post-analysis at the end of 2014, and I was eager and I was confident that I would recover. I mean, Livermore recovered from worse, so I would too. I had success in turnaround plays in Lululemon and Mobileye. I did well in NXPI Semiconductor. I even caught the turn in Tesla, this time sticking to the stock, not the options. Toward the end of June, I was up nearly 30% compared to the Nasdaq's 9% gain. I was still well off my peak, but I was making progress. In August of 2015, we had the flash crash. The NASDAQ fell 18% off the peak, most of that damage occurring in 4 days. And I was hit hard. I gave back the bulk of my gains for the year, but I also participated in the bounce. So by the end of September, I was still up 19% on the year compared to the NASDAQ's 1.6% return. But from that point on, I really struggled. You can see how choppy the market was. It was in a sideways, choppy consolidation. It was really too difficult to make money, particularly on the long side, probably on any side for that matter. It was a stay-away market, except I wasn't staying away. I closed the year down nearly 9% compared to the NASDAQ's 6% gain. I was now 60% below my all-time peak in under 2 years. 2016 was another volatile year in the market. It was a really tough year. The NASDAQ was up 7.5% by year end, but the choppiness and the headline risk made it really difficult to navigate, even for the very best traders who were on their game. But for me, who was in the midst of a devastating losing streak and had completely lost his way, it was next to impossible to trade well. When your head isn't screwed on straight, the rule is to simply stop trading. Take a break. The market will be there when you come back. And when you do come back, you start off small, right? You test the waters, you test your ability to stay disciplined. But I kept trading full force, ignoring the fact that the market was not in an uptrend and breaking every rule in the book. The first part of 2016 was terrible. There was a 19% intermediate correction, followed by a recovery, and then sharp pullbacks related to Brexit, and then the presidential election. It was just a really tough market to trade. And as you might expect, I came back to my white whale, Tesla. I bought it at the tail end of 2015, just days before the market was about to break wide open. And I bought it on this premature breakout above resistance. Don't ask me why. No, it's not a proper pattern. At the time, I was just trying anything. I was pretty desperate, hoping for something to work. I was not in a good state of mind. The fact that it broke down a few days later on heavy volume, a gap down, did not dissuade me. I had become the proverbial long-term investor. I was done taking losses, done. I knew in my mind that it would come back eventually, and I was going to hold it no matter what. Now, the funny thing about the market is that it has an uncanny way of knowing your breaking point. And everybody has a breaking point. I always say the only way not to capitulate is never put yourself in that position. I held on for dear life as that stock kept falling, along with the general market, day after day. I buried my head in the sand and I tried not to look. By the time it broke 150, I was in full-on panic mode. I was afraid of completely blowing up and losing everything. I finally came to my senses and capitulated, suffering a 40% loss in 6 weeks. I was completely devastated. But I was also thankful to be out of the stock. No longer a believer, I thought the stock would break another 50 to 60 points. What the hell do you think happened next? This is what happened. Holding it, the stock shot up 90% in 2 months. I can't believe I'm telling you this. I lost so much money, it's hard to comprehend. I was now 77% off my highs in 2 years. I had never experienced a streak like this. I stopped talking to my wife about trading. I was ashamed, I was embarrassed, I was depressed. I just kept it all to myself. But she knew it was bad. You cannot hide this kind of damage. But I still had a stake, even if it was just a fraction of what I had at my peak. And even though I had completely lost my discipline and couldn't seemingly put on a winning trade to save my life, somewhere deep down, I believed in myself. I had started with virtually nothing. I had built it up into something significant. Everything I owned, everything I had in a material sense, my whole way of life, standard of living, came from my profits in the market. And as bad as it was, I still had a significant stake compared to what I started with. So I knew that if I could get back in the zone, I could rebuild my fortune. Now, you would think that after the second Tesla debacle, things couldn't get much worse, but you would be wrong. I believed that I could right the ship, but honestly, guys, I was pretty effed up. You can only imagine the kind of stress I was under. It affected every part of my life. My marriage, my kids, my career, everything suffered. Now, we didn't live an extravagant lifestyle, but we had a very nice life. My kids were in and have always been in private schools, private college. We did a lot of entertaining, and we had expenses. I was constantly pulling money out of the market to make up the difference. The stress I was under was off the charts, and I was completely exhausted. Trading is a demanding profession under the best of circumstances. It requires you to show up every day and be at your best, to be at the top of your game. If ever I needed a break, it was now. I've never taken a break in 20 years, actually 25 years, and I was burnt out, but I kept going. Instead of taking a break, I committed to finding the next big winner that would dig me out of this hole. I was going to find the next huge multi-year model book stock. Now, in July of 2016, a rally happened amongst the fiber optic stocks, and that played in perfectly with my new plan to find a big winner, a new big secular growth stock, and a secular theme. And so, getting on board the fiber optic trade, I made money in Lumentum, Aclaro, and Finisar. But the one I really wanted was Acacia. This was going to be my model book stock. Acacia was a new hot IPO in the fiber optic space. It had amazing earnings, huge estimates, and a reasonable valuation. But I hesitated. Being in the frame of mind I was in, I needed to be sure that this was going to work. I was afraid to buy something that was unproven and sticking straight up in the air. So I waited and I watched. And I watched. And I watched. And I watched. The stock was up 170% in 9 weeks. Finally, I had an opportunity to buy on a pullback to the 21-day moving average, averaging in around 107 a share. Now, as you might expect, I was armed with a historical precedent. My old standby First Solar from 2007. Now, you would have thought I would have given up on this sucker by now, but what can I say? Sometimes they work. The similarities are obvious. First Solar was an IPO, broke out of an IPO base, ran up, had a huge gap up, pulled back to the 21-day, went to new highs, pulled back to the 21-day. Acacia, new hot IPO, broke out of an IPO base, gapped up, pulled back to the 21-day, new highs, pulled back to the 21-day. Yes, the stock has already been up a lot at this point. But based on the First Solar move, there was another huge move right around the corner. In the 4 months following the second pullback in First Solar, the stock rallied 140% in 4 months. So I was ready to clean up in Acacia. This is what I was expecting. I sold my current holdings in the other fiber optic stocks at a handsome profit and positioned myself aggressively in Acacia. I wasn't going to pass up this opportunity to make back my losses in a stock about to double. I loaded up and I waited for good things to happen. But once again, the historical precedent didn't work. Acacia started to falter. After a one-day bounce off the 50-day, the stock gapped down on a secondary offering, decisively breaking below the 50-day moving average, closing at the lows. This is a clear and ominous sign to bail out. We all know that. The stock looked like it was heading lower, maybe a lot lower. I couldn't believe it. What about my model book stock? Could this really be happening? How is it possible for anyone to be this unlucky? I was seriously thinking that there was someone out there that put a voodoo curse on me. Well, obviously the thing to do was to sell my position and cut my loss. But sell I did not. What I did do was dig in my heels and become an expert on the fiber optic industry. Now, I am being deadly serious with you when I tell you I am very, very technically challenged. You can ask Mike Webster. Pretty much my only strategy to fix anything electronic is to unplug it and plug it back in. So for me to understand anything as complex as the fiber optic industry and coherent transmission is next to impossible. And yet, I read everything I could get my hands on, and I did my best to understand the space and Acacia's unique market-leading optical internet products for the data center. And I am not exaggerating when I tell you I had a binder this thick filled with articles devoted to this. I mean, you should have seen me. I was listening to the conference calls. I would listen to how the analysts asked the question. I would listen to how management responded, and then I would try to interpret how the analysts responded to management's response. I mean, it was crazy. I mean, I was literally out of my mind. The ego will make the most elaborate justifications and rationalizations to keep you in a losing trade. It will cause you to ignore the most obvious facts and focus instead on any shred of evidence to support your position. It will protect itself from being wrong at all costs, even if that cost is losing everything you have. The lower Acacia went, the more my knowledge grew. I was reading the press releases. I was reading the press releases of their competitors. I was watching YouTube videos on fiber optic technologists. I was reading and rereading the analyst reports over and over again. Every single one of them, without exception, had a strong buy rating on the stock. How could it be possible that all of us could be wrong? Bill's voice haunted me. The market is always right. Opinions are often wrong. By year's end, I capitulated. I had a large portion of my account in this loser, and I was down nearly 50% on the stock. I was down another 58% in 2016, 83% off my all-time high. Just a few years earlier, I could have stopped working altogether and lived a very comfortable lifestyle of travel and play. And now I found myself in this horrible predicament and stress beyond belief. 2017 was a huge year in the markets. The NASDAQ was up 28%. But as you would expect, I was in no condition to trade. Honestly, I was a complete basket case. It was time to tell my wife where we were, and it didn't go well. She had had enough and wanted off the roller coaster, and I couldn't blame her. We officially divorced at the end of 2018, after 27 years of marriage. We continue to be the closest of friends and excellent co-parents. All I can tell you is that it is extremely difficult and painful. It was just a difficult and extremely painful period of my personal life. I would not wish it on anyone. Things actually got worse in 2017 before I hit rock bottom. And I was depressed, I was confused, I was embarrassed, I was ashamed. I ended that year flat. And the turmoil in my life really persisted through 2018, somehow coming clean as to what had happened and where I was, where I stood, helped me to focus and get back on track. I was able to make some progress in the first half of 2018. I closed up 23%, outpacing the Nasdaq's 9% gain. At that point, we separated our assets and the account was frozen until the divorce was final. Okay. So you are probably thinking, how on earth did you let that happen? And trust me, I have wrestled with that question for the past 5 years. I even have a therapist that's helping me grapple with it. How does a person who is clearly so capable of succeeding in the markets and was able to achieve spectacular heights end up sabotaging himself with a string of bad choices that fly in the face of everything he knows and everything he teaches? Well, this is where we move from trading psychology to just psychology. Yesterday, we talked about the mindset of the consistent winner and the rules that you have to follow if you're going to be successful. And there's nothing complicated about those rules, right? Cut your losses quickly, let your winners run, add to a winning position, not a loser, trade in line with the market, don't overconcentrate, predefine your risk, and so on and so forth. But it's one thing to know these rules and another thing entirely to follow them religiously on every trade. The interesting thing about trading is that you can follow the rules perfectly 99 times in a row and have huge success. But if on that 100th trade, you violate one or more rules with a big position, you can unravel all your previous success in virtually no time at all. 99 good decisions wiped out with one really bad one. It is no different from a recovering alcoholic having one drink after 20 years of sobriety and starting all over again. When I think about it, probably 3/4 of my losses in terms of money were the result of 3 disastrous trades, 2 in Tesla and 1 in Acacia. So the question again, after so much success, after so many years, why did I break virtually every rule in the book? Well, I can't speak for other boom and busters like Niederhofer or Livermore, but my own personal journey of reflection, awareness, and growth has led me to this. I sabotaged my success because deep down, I didn't feel I deserved it. I didn't feel worthy. How I felt on the inside wasn't matching up with how I was doing on the outside. So unconsciously, I did something about it and put the two in line. Now, I wish I would have invested in some therapy before I lost all that money, but it is what it is. When I was at my peak, why was I thinking about mansions in Malibu and throwing lavish parties? I was already living a pretty nice life. I still am, but I wanted more. Was I trying to prove to everyone how smart I was, how rich I was, how successful I was, because I didn't feel it on the inside? The truth is that no amount of money or empirical success can compensate for a lack of worthiness. As my therapist said, it's really cool to make $1 million in a day, but it doesn't make you a better man. So what exactly is worthiness. Worthiness is a feeling that I matter, I'm valued in an authentic way. How do we achieve worthiness? How do we find value? Well, this is where the hard work comes in. This is what I'm working on through therapy. Feeling valued, feeling a sense of worthiness comes from connecting with others through relationships. It's an internal thing. Seeking value externally doesn't work. It's a slippery slope when you equate your sense of value with money, status, cars, houses, possessions, and so forth. I mean, do you ever really have enough money? Isn't there someone else out there who has more than you? When you link more money to more value, you're in trouble. Money will never be enough if you don't feel authentically valued by another person without judgment. Now, I'm sure that each of us is dealing with our own demons, but I'm betting that I'm not the only one dealing with a sense of worthiness. In fact, I think it's pretty common amongst most people. So what can a person do? Well, again, this is where the hard work comes in. Anyone can figure out what they're doing wrong, but figuring out why is another thing entirely. It is not enough to do a post-analysis, figure out what rules you break, and promise yourself you'll never break them again. If that's all it took, we would all be consistent winners. In fact, when I go back through my trading journal over 25 years and look at what I wrote after each successive fall, it turns out I write the exact same things every single time. I knew everything I needed to know about trading 25 years ago. So we have to go deeper, or at least I do. Now, how many of you are familiar with Brene Brown? All right, a few of you. She has a TED Talk on the power of vulnerability. I recommend all of you watch that TED Talk. It's one of the 4 or 5 most watched TED Talks ever. It's got millions and millions of views. Since most of you haven't seen it, I will summarize. Basically, Brene Brown's an academic. She's a PhD in social work, and she's a social worker. And she studies connection and what gets in the way of it. And connection is why we're here. Okay, connection is what gives meaning and purpose to our lives. And what she found is that what gets in the way of connection is shame. Is there something about me that if people knew or if people saw, I wouldn't be worthy of love and belonging? And the thing about shame is that it's universal. On some level, everyone feels this. Either I'm not good enough, I'm not smart enough, I'm not rich enough, I'm not beautiful enough, and so forth. So for connection to happen, we must allow ourselves to be seen, really seen, and that requires vulnerability. Vulnerability being an act of courage, not an act of weakness. And what she found was that the difference between people living with a deep sense of worthiness versus those who struggled for it was that it was a sense of courage, a courage to be imperfect. These people were willing to let go of who they thought they should be in order to be who they are. And that answers the question as to why I decided to take you on this journey as a trader. It's a part of my own healing process. Relating it back to trading, if you're living and trading from a deep sense of worthiness, then you really don't have an ego to protect, which means there's no reason to rationalize and hesitate, overcommit, average down, refuse to cut losses, and all the trading errors that we make in protection of our ego. I'm guessing that the consistent winners don't have an internal deficit to fill. They're not looking for the market to fill some hole, to fill some void, so they can act and follow the rules without any internal conflict. Now, I think everybody probably has their own crap to deal with You may have other issues, you may have other limiting beliefs, but the point is that until we figure out what's holding us back from reaching our potential, we will continue to sabotage the success and struggle to become truly consistent winners. So now you have some insight on what possessed me to share this story with you. Truthfully, I had some reservations. I had a lot of reservations. Let's face it, it's kind of embarrassing. I'm not terribly proud of how it ended. But then again, it hasn't really ended, has it? A bad chapter doesn't define your story, or doesn't have to define your story. While greatly diminished, I still have a stake. I still have the opportunity to rebuild. And that's a great thing about trading, and a great thing about the markets, is that the market is always open, offering a constant, never-ending stream of opportunities. And as long as you have a stake and the right mindset, the possibilities are limitless. Now, am I a little bit bummed that, where I am now compared to where I was at my peak? Of course I am. But I'm not as discouraged as you might think. When I think about where I was 25 years ago with virtually nothing and what I was able to do with it, I know that in time, I'm going to reach new heights. It's not really a question of if, but a question of when. But I don't have a timetable. I don't know how long it'll take, but I know this, that when you're in the zone, things can happen pretty quick. This year, my Roth IRA is up 54%. My margin account that I refunded back last year is up 182%. So I'm on the comeback. The question is, when I recover, will things be different? Will I be able to hold on to it? Have I become a consistent winner? So the answer to that question is yes, but talk is cheap. The truth is, I always feel a new sense of confidence and inner strength when I'm trading well. So I'm going to have to let the results speak for themselves. The truth is, I'm a work in progress, and we'll just have to see. So to wrap up, my hope is that you are able to learn from this experience, realize the incredible potential there is in the market to build wealth, as well as the ever-present potential to sabotage and squander that wealth if you lose your discipline. If you haven't yet achieved the status of consistent winner, don't give up, don't be discouraged. Most elite traders who fall in that group lose one or more fortunes along the way. It takes that in order to have the mental shift and growth to develop the winner's mindset. Just like you can't build muscle without anything to lift, most people can't become consistent winners without inevitable setbacks. So good luck. Thank you. Thank you. Thank you. I really appreciate that.